You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Welcome to Best in Class per Sector, part number 2. Today, we are looking at 3 sectors, but and a bunch of stocks, but mostly in the financial industry. But we're going to start with the energy sector at first. You know me, I'm not a big fan of the energy sector, mostly because those companies have absolutely no control of the most important part of their business, which is commodity prices. However, Canadian Natural Resources and Imperial Oil, so CNQ and IMO, are kind of like the 2 major exceptions in this field. Of course, you're going to tell me about Enbridge and TC Energy. They're showing like 27, 28, 29 years of consecutive dividend increases, so almost like 30 years, which is kind of impressive. But they have both slowed down so much over the past few years. The dividend growth is now back at 3%. So I don't know, like it's great for income. So don't get me wrong, if you're just looking for income and you don't care about total return, probably that those pipelines are still solid. But I'm still a bit reluctant because of the lack of growth, because of the weight of like labor cost, maintenance cost, inflation overall, the interest charges. So I just see a lot of expenses piling up for those pipelines with very limited growth potential, that I'm not too sure I would put money on those. However, CNQ and IMO are completely different beasts. So both of them are vertically integrated, and they've done it in a way where they are profitable even if the oil price is below $40, like around $40, I mean. So those companies right now, in a world where the oil barrel is trading above $75, sometimes at 80, sometimes at 85, sometimes at maybe 90 at one point, but they're making a ton of money. So they're buying back their shares, they're increasing their dividend, they are paying off their debt. So they do everything by the book, super well managed companies. My favorite one in this case is Canadian Natural Resources. I do have an investment in this one. That's my only energy play across all my portfolios, just to tell you. It's not a huge portion though. I would never put like a lot of money there. And even then, while right now they're doing great, if you look at Canadian Natural Resources for a good 10 years after the financial crisis, the stock price didn't move much. So it's not always a super powered type of business, but it is generating a ton of cash flow. So that could be quite interesting to have it in your portfolio. If you are looking for more ideas like this, I use the DSR Rockstar list to find all my stock picks. Whenever I have money on the sideline and I want to invest in my portfolio, I use the Rockstar list as the first step of my research of my investment process. So the Rockstar list is a list of all Canadian and US stocks that shows a positive dividend triangle. So only companies showing revenue over the past 5 years, earnings per share, and dividend growth that are positive for the past 5 years. So at least minimally growing businesses. So you can download it for free at moosemarkets.com/rockstars, moosemarkets.com/rockstars. And every month I'm going to send you an updated version of this list. Now, moving on to the financial sector. Oh, we love those financials as Canadians, right? Of course, I'm going to tell you a little bit about Canadian banks, but we're not going to spend too much time on that. National Bank, Royal Bank are my favorite by far, mostly because they have something in common, their diversification. So 50% of their business model is about classic banking activities, mortgages, loans, savings, commercial business, and the rest of it is geared toward other sources of income such as capital market, insurance, and wealth management. Now, speaking of wealth management and asset management, two other companies would make my list, and they are Brookfield Corporation and Brookfield Asset Management. I combine both because Brookfield Corporation owns 75% of Brookfield Asset Management. So BN is the mother company. And it is a asset-heavy alternative asset manager, which means that on top of receiving money from pension funds and retail investors and charging a fee to manage that money, they also invest their own capital. So whenever they sell an asset at a profit, they can double down on it because yes, they're going to attract clients and they're going to charge fees on those gains. But on top of that, they're also cashing a part of that profit in their pockets. So if you're looking for low yield, high growth, you go for Brookfield Corporation. If you prefer to have something geared a little bit more towards income, you can go with Brookfield Asset Management, BAM. And BAM is an asset light alternative manager. So they are managing the same type of assets, but Brookfield Asset Management is only receiving money from pension funds, retail investors, and so on, and they're charging fees on it. So very sticky business model, recurring revenue, very stable, and it offers a yield that is close to 4%. So pretty interesting if you're looking for income as opposed to Brookfield Corporation that is a low yield, high growth stock offering like a 0.75% yield. So depending on what you're looking for, you get your two picks. I have to talk about EQ Bank for a second. It is a very small bank, so not comparable to the big six. We're talking about a market cap of like roughly 2 billion right now. So nothing like completely crazy. However, EQ Bank has been, it's at 3.6 billion, my bad. So recent great performance kind of jumped the market cap to almost 4 billion. So that's pretty cool. So EQ Bank has been very aggressive on the digital world, offering very high yield for their savings account and their GICs. They kind of like make their trademark of like classic and optimal banking for the people. So really minimizing fees, improving the experience. And let's be honest, the big six are they look like dinosaurs compared to EQ Bank in that regard. So they continue to do very well in this environment and they continue to grow, which is definitely interesting. In the insurance world, my favorite one by far is Intact Financial, IFC. IFC, why? Because they are a leader in personal and commercial insurance in Canada. They have doors open in the US and also in Europe, notably in UK. And what I like about them is, as being a leader in Canada, they have a lot more information than anybody else. So they have a lot more data, and the insurance business is all about how you write your premiums and you manage your risk. So the more data you have, the better you become and the higher the chance that you write great premiums and you make a lot of money on those. Finally, there's one more stock that I want to discuss, and it's TMX Group, ticker X. This one, a little bit more flying under the radar, not a big yield, kind of like a weird company because it's like offering... It is managing actually the Canadian market, the TSX, and they're making money by like offering trading services, IPOs, selling financial information as well as data centers. So the financial data information center, So a lot of information over there. Very strong dividend triangle. Most of their business is quite recurring because as long as we invest, regardless if we sell or if we buy, they're going to make money. So that is a very interesting business model, kind of like a monopoly as well. They do face competition in selling their information, or the NASDAQ actually enter the Canadian market through acquisition. So there are some competitors over there, but overall a pretty solid business model. I am going to skip the healthcare sector because there's no dividend there's no dividend stocks in healthcare in Canada that deserve my attention. So a few REITs like Sienna and Chartwell, but they're more REITs than healthcare focus, and they're not really like focused on dividend growth anyway. So I never mention any healthcare stocks on the key inside because of that reason. I don't mind if there's like some great biopharmaceutical that are like offering a next coming up blockbuster or something. If they don't pay a dividend, it's not on my desk, and I rather stay aligned with my strategy. So all right, Moose, that's enough for today. Next tomorrow, actually, we are going to talk about two more sectors, so the industrial and the technology sector. So it's going to be mostly about industrial, let's be honest, but it's going to be fun. So it's coming up tomorrow. And in the meantime, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.